one other thing that makes me bullish on upcoming Q2 earnings is you have to remember when Q1 earnings were reported. In general, that was like late April into maybe early May. And remember what the environment looked like with all that tariff uncertainty and volatility. When these companies guided, if they guided at all, they were very conservative with their outlooks for Q2, and many didn't even guide for the full year. And so you've set an incredibly low bar going into this upcoming earnings season. You throw on top of it the fact that the S&P 500 has 40% of revenues coming international, and the dollar has gone from an average of 107 to 100. So you've got a 7% benefit to 40% of your revenues. So that's huge for them as well. I think you're going to see that as another reason that you have very strong Q2 earnings.
All right, welcome to the Risk Reversal Podcast. I am Dan Nathan. I am joined by Dan Niles. He is the founder and portfolio manager at Niles Investment Management. Dan, welcome back to the podcast.
My pleasure, Dan.
Listen, I always appreciate you making time. And one of the things that I think is so unique about you is your willingness to, really detail, I want to say like on a month to month, definitely on a quarter by quarter basis, what you were doing, what you were thinking. And it's not like many of the PMs that come on CNBC or other media, whether it's podcasts or other channels, they're not always being as transparent. They learn how to talk out of both sides of their mouth, depending upon what the market is doing. And I see you laughing there. You get what I'm talking about. And if you look at your Twitter at Daniel T. Niles, you basically detail, what you were doing, why you were doing it, really long post. So great stuff there. And I'll just say this as a little housekeeping. If you want a little more information on what Dan is doing, you can go to nilesinvestmentmanagement.com. All right, Dan, we got a lot of stuff to go through. You just put a mid-year update out, like I just mentioned on Twitter. So I really want to hit a bunch of that. And it's not just tech stocks. You get into the macros. So I want to detail a little bit about that. The other thing I want to say is I'm out in Jackson Hole right now. I'm at the Balyasny BAM Elevate Investment Conference, a lot of private companies and a lot of VCs. And it's really interesting. One of the themes here, there's a lot of space tech and defense tech, and we're going to spend a lot of time today on just AI in general and where a lot of these private companies are applying this technology. But one consistent theme is just how far behind the US is versus China in almost every single one of these verticals. And I'm just curious, as you look at the public market landscape, is that a theme?
Yeah, I don't see the US being behind, but what I do see is a very big difference in how they're approaching it, which could cause problems in the long term. And what I mean by that is you have about half the world's AI researchers sitting in China. So that's obviously much bigger than their share of global GDP. And so they're not as far behind on this technology as they have been on every other technological advancement that's occurred. So that's the first thing that makes them much more competitive. The second thing, which matters over the long term, and you saw this as you rightly pointed out with DeepSeek, is that because we were cutting off chips to China, necessity is the mother of invention. They had to come up with more efficient ways to use the hardware that they had. Whereas in the US, you've got these behemoths like Google or Amazon and Microsoft, and you can say, well, I don't need an efficient AI model. I can throw a ton of hardware and buy a ton of GPUs, the highest end GPUs, and just throw money at the problem. So those are two very different approaches. And over the long term, having something that's very efficient and that can run having to expend less capital, the ROI is much higher on. From that perspective, China is actually doing much better. And a lot of the things DeepSeek introduced, because I went through that paper and I actually put out something on the DeepSeek paper, way back when it came out. They made some massive cost reductions where you're talking 90% plus improvements in the cost to produce a token, which is kind of the unit of a measurement in AI. So I think you're right in that you don't want to underestimate what China is able to do right now.
This is just a theme I think that's going to be around for a very long time. And one of the things that I know is like this is essentially planned economy. They have the ability to get behind some of these industries or some of these companies that they deem to be national champions, and that's one of the major disadvantages you would say for us. If you think about the primes, as you talk, as they say in the defense complex, they are so far behind. You know what I mean? Cutting edge technology right now. NASA seems like a dinosaur. And that's one of the reasons why I guess SpaceX is almost like a single source. And think about not just for getting astronauts back from a space station when a Boeing, spaceship can't do it, but also deploying, thousands of satellites.
No, and it's true. And I think that's the good news right now with the current administration is they're obviously very focused on defense technology, but probably more importantly, they're focused on very cutting edge defense technology for things like drones. We have some investments that we put into that space recently. That kind of stuff where it's not driven by people, it's driven by technology. I think that makes things up much better for the U.S. looking forward in terms of upgrading our technology. And we see how impactful drone technology has been in the war in the Ukraine and also even with the Middle East situation.
One of the themes that I keep hearing throughout these panels is just how dumb these drones are right now. They are not using AI. And so I just think that's kind of interesting. It presents a huge opportunity. And it's probably one of the reasons why you are looking at the space. Let's talk a little bit about the macro, because I think this really informed how you came into this year. Your most favored position was cash. We had a macro induced, let's just call it, policy induced sort of volatility that started in kind of late March into April. It was the sort of crescendo that you and I have probably only seen maybe a half a dozen times throughout our career, the speed in which the market sold off, but then also the speed in which it came back. And then really just kind of how you're thinking about trade and tax and some of these other situations, the dollar weakness and yields stuck here around 4.4. How are you thinking about the macro and how has it informed your positioning in the last 6 months or so?
So if you think about the macro, I came into the year, as you said, negative, and cash was my favorite pick because I felt like people were focusing on all the positives and not potentially some of the negatives. And I also thought that big tech would have poor earnings. If you go back and you look at reported Q4 results and then guidance for Q1, 6 of the 7 Magnificent Seven had their forward revenue estimates get cut for the March quarter after they reported the December quarter. So you had a problem with the most important companies' earnings. And a lot of those issues, actually, if you go back and you look, like I started talking about a digestion phase in AI in the middle of last year, and it was driven by my thoughts on the big hyperscalers. And if you look at it, when Amazon, Google, and Microsoft reported their June quarter of last year, the revenue estimates for September got cut for all three. That happened again when they reported the December quarter of last year. The numbers all got cut for revenues for March. Now, what changed was as we went through that volatility in April, I thought the market had kind of hit bottom in early April. It looked scary there for a couple of days. I had a CNBC interview on April 7th saying, I was shortening volatility and this could all be fixed with a tweet. 2 days later, on April 9th, President Trump rolled back the tariffs and the market was up 9.5% in a day. If you look at where we are right now, I feel the same way about Q2 earnings as I felt about Q1, which is, hey, the dollar has gone down a fair bit from the highs. You're going to have this pull forward in demand because people are afraid of tariffs. Apple famously airlifted 600 tons of iPhones to try to get in front of the tariffs. And you've had consumers buying high-priced items where they think prices are going to go up in the latter part of this year as you get towards the holidays because of the tariffs. So things like automobiles, smartphones, PCs, high-priced items that moving up 5-10% in price, that's really going to make a difference. But the problem with that is if you look at the things like import data for the United States, where the US is 25% of total GDP, and you look at Q1 GDP for the United States, within that number, imports were up 38% year over year. So that tells you that you're probably going to have an issue at some point where you're going to have to pay that back. And my guess is that starts to happen between that Thanksgiving to Christmas time period where retailers do typically 30 to 35%. If you're an electronics company, you do 30 to 35% of your total sales for the year in the months of just November and December. And 15% of that is jammed just into the 5 days between Thanksgiving and Cyber Monday. So my feeling is much like I thought Q1 and now Q2, things will look great because of pull forward. I think you're going to have a big issue in Q4 when that pull forward leads to less than expected demand. One other thing that makes me bullish on upcoming Q2 earnings is you have to remember when Q1 earnings were reported. In general, that was like late April into maybe early May. And remember what the environment looked like with all that tariff uncertainty and volatility. When these companies guided, if they guided at all, they were very conservative with their outlooks for Q2, and many didn't even guide for the full year. And so you've set an incredibly low bar going into this upcoming earnings season. You throw on top of it the fact that the S&P 500 has 40% of revenues coming internationally, and the dollar has gone from an average of 107 to 100. So you've got a 7% benefit to 40% of your revenues. So that's huge for them as well. I think you're going to see that as another reason that you get very strong Q2 earnings combined with that pull forward in demand that we talked about.
So here we are mid-year. You have deployed capital over the last couple of months. Some of the themes in which you were very focused on over the prior 2 years are some of the favorite themes that you have going into the back half of the year. And so obviously trade and tariff as it relates to Nvidia are going to be at the forefront. It's just, yesterday, I guess it was, where there was some of those export bans on the H20s from Nvidia to China were just lifted. A huge rally in Nvidia. I think it was up 4.5%. How are you thinking about what the potential outcomes are for these semiconductors? And this is Wednesday, right after the opening or shortly after the opening. And we have ASML down 10% because they pulled back some of their guidance for fiscal year 2026. And I think that's interesting because they're talking about the uncertainty about a potential trade war. And when you think about that, you say, oh my God, that is so April 2025, because, think about it. The NASDAQ's got no fear. It's up nearly 8.5%. It's up 30 some percent from those lows. If we start hearing more of that, if we start hearing, okay, maybe that was just a brief reprieve for the H20s, that sort of thing, will that be a massive headwind? Because right now, I do not think the potential for that is discounted anywhere in the market right now.
Yeah, it's totally not discounted. And the ASML stuff is super interesting for the following reasons. They're at the very, very tail end of the bus in the sense that if you have a company, let's say that's a semiconductor manufacturer, and they're kind of thinking long term, these are, each tool is like 250 million bucks. And it takes a long time to get them because they're so hard to build and manufacture. And so if ASML is saying, hey, we're looking at 2026 and we don't know, as they said, we can't be certain that we're going to grow, which is why the stock's getting clobbered. That means that their customers who are thinking out super long term are saying, we may not need these tools that are $250 million each. And so let's not place those orders. And so they're seeing something, and that something is much longer term. And that has nothing to do with how good Q2 is going to look or guidance is going to be, which I think is going to be actually pretty decent. And a lot of that's just driven by the dollar going down 7% from Q1 to Q2, right? Which helped with that 40% of revenues of the S&P that's international, right? That's an immediate 3% boost top line. But I looked at that and I was like, well, that is fascinating because tool demand has also been pulled forward, right? If you're worried about the U.S. cutting off your access to these super high-end tools, which one guy in the world produces, then you go, well, maybe they've already pulled forward a ton of demand, and maybe we're starting to see the other side of that. So yeah, to your point, the commentary was very, very interesting, and especially given where ASML sits in that food chain, I paid it even more attention. But you got to remember, like investors right now, they just don't care. Valuation, it doesn't matter. When you've got indexes going up and more of the money is passively indexed, an index ETF doesn't care. It goes and buys every stock in that index. retail investors who are playing around with zero data expiration options, they could care less about valuations, right? And valuations matter at turning points, whether it's when things are massively oversold, which is when it works really, really well. On the upside, though, valuations can get absolutely crazy, which is why I wrote in my note, don't worry about valuations right now until you have to, because if you go back and, I'll pick 1999 and 2000 as an example. Like, I think in 1999, NASDAQ was up like 86%. And then in just 2 months in 2000, it was up like 24%. And then we know what happened after that. It went down 78% over 2.5 years. But it tells you that as you're walking towards that cliff, nobody cares until they care, at which point then valuations matter. And so right now, with the markets just levitating and people just ignoring bad news, right? There was a whole bunch of tariff noise over the weekend, and Monday the market's up anyway. So that tells you people just want to believe. Now, there's a few things that should make you nervous, like, you're looking at the 10 and 30 year and you're going, well, 10-year treasuries at 4.5, the 30-year treasuries at 5. You look at Japanese 10-year yields yesterday, they went to a new record high, surpassing the levels they got into in March. It's over a decade high. I think the last time 10-year yields were this high was back in 2008 for Japan. And so that affects the carry trade. And, that's getting a little wonky here, I know.
But Dan, not really. A year ago, this very, period that was going on, what you just described, the rise in JGBs and the carry trade got unwound, and it really did have a negative impact on our market. So it's funny that you bring it up. And, you are a tech investor for the most part, but you're paying very close attention to the macro, and that is on your bingo card. And I think it's important for folks like you to remind all of us, because it's not just the macro wonks that are taking a look at these sorts of relationships. It's PMs like you also.
Yeah. And I think that's the part tech investors always miss. I mean, I remember in 2007 or 8, I was giving a presentation to this massive tech software company, and I started off my presentation talking about the housing market. They kind of stopped me in like 5 minutes in and going, "Why are you talking about the housing market?" I said, "Because I think this is going to matter." And don't forget, I was employed at Lehman Brothers at the time. And so, and obviously the housing market did kind of matter to tech demand because the world's interconnected. And if you're in a downturn or in a period where the cost of money is going up like it is right now, people may decide, you know what, I can hold off on upgrading this or that. And if AI is making things more efficient, then maybe I can hold off on these hires, which means that seat licenses for software companies, I don't need as many seat licenses. So there's all this stuff is interconnected. And with valuations, which you rightly have pointed out, are very high, which is part of the reason I came into the year negative. I'm like, if there's any kind of issues with the macro, valuations at 24 times right now for the S&P 500, when CPI is normally between 2.5% to 3%, the S&P historically is traded 19 times. So you're 20% more expensive than you should be. And you've got a lot of negatives on the macro level, like debt to GDP being really high. You've got debt to GDP going up 6 to 7% every year from these current levels. And so there's other stuff in the background that should make you nervous, but nobody's going to care until there's an issue. And that's why I've sort of said, I'm trying to enjoy the ride between now and Thanksgiving, because I think investors will put the blinders on and go, the market's kind of going up. There's a lot of FOMO out there. If you're a professional portfolio manager, a lot of guys miss the rally from the bottom. And so there's going to be performance chasing. And I think that just creates this melt up scenario potential that I think gets massively hit, where I think the S&P could be down 10 to 20% between Thanksgiving, as we approach Thanksgiving through the year. That's how I'm thinking about it. But in the near term, people always go, "Oh my God, he's so bearish." And I go, well, I'm positioned for the market to continue to go up, because you can be picking up pennies in front of a steamroller. But if it's like 1999 to 2000, where the NASDAQ's up 86%, then it goes up like 24% in 2 months, that's a lot of performance to give up. And you hope you're smart enough or recognize the signs to get out in time. And so that's kind of how I'm thinking about things.
Well, I mean, listen, you and I have known each other for a long time. And in a period like this where you are bullish, but you're laying out a case where you think that sentiment could turn, right? Where where the like business cycle could turn. And again, this goes back to your transparency. We will know. You will be on CNBC. You will have laid out, like the way you just did, a very detailed sort of landscape for just not only on the micro, but obviously on the macro. And you like to meet in the middle. So that's something that obviously we'll all pay attention. And the other thing I just wanted to give a little shout out, you were on a really good friend of mine and yours, Wilfred Frost, brand new podcast, Master Investor. I want to say a couple weeks ago. It was a great conversation and you really dug into your process. And there was a lot of history there in that conversation. And we'll put that podcast in the show notes because it was great. And Will's doing a great job. He's had a murderer's row of investors over the last month or so. So check that out. All right, let's talk about what could go wrong, because one of your other top picks right now has been Microsoft. Microsoft has rallied 45% from the April lows. I also think it's interesting if you go, not you, but I know that this is imprinted in your brain, but if the listener wants to go and look at a chart of Microsoft in the summer of 24, it made an all-time high, and then it didn't make a new all-time high until just recently. And I think that's interesting because, for the back half of last year into, let's say, February 19th, where the market had topped out, Microsoft had been lagging a lot of his Mag 7 peers. And so when you see the sort of performance, it had that huge gap after its calendar Q1 earnings. I think it was like 8% or something like that. We haven't seen a gap like that in Microsoft in a very long time. And it just kept on going up in a very low vol sort of basis. So how are you thinking about it into, let's say, in 2 weeks or so when they report? Is there potential downside? And what are you expecting? And what do you think the risks are into the print?
I love Microsoft. And the reason is I was negative on that from the middle of last year, along with Nvidia. If you go back and look at Nvidia stock was basically flat to down for a good portion of time too, because of Microsoft. Because if you think about this very big picture, Microsoft, when they reported the June quarter, Azure was a disappointment, which is their AI business, their cloud business. When they reported the September quarter, Azure was a disappointment. When they reported the December quarter, Azure was a disappointment. And don't forget, Microsoft was an investor in OpenAI back starting, I think, in 2019. We only heard of ChatGPT from OpenAI in 2022. So they were early on this AI train, and they were the biggest CapEx spender. I think their CapEx last year was up like 8% or something on a calendar year basis. And so they started pulling back on that spend. Kind of, if you look at what they were saying from the middle of last year through early this year, where they were talking about, hey, we can't get chips. Then it was, well, we kind of can get chips, but power is the biggest issue. Well, now we're looking forward to renting capacity versus actually owning capacity. And this is all what the CEO is saying. And then finally, they said recently, yeah, we see our CapEx growth growing at about the same pace of revenues. And by the way, revenues are growing in the mid-teens. So you're talking about a company that was growing CapEx at close to 80%, now saying they're going to be growing at probably mid-teens by the time we get to June. So the good news with that is if you are spending an ungodly amount of money, the cash flow gets crushed. The stock's struggling, and the top line has been going down for 9 months. They reported the March quarter, and it was a dramatic reversal. And I think part of that is the deal they did with OpenAI during the Stargate initiative, where they get to keep the traffic that they want from OpenAI, which is the high margin, higher growth inference traffic. And then they can take things like the training traffic and say, hey, somebody else can have it. And their cash flow goes up a ton because now they're not spending what they were earlier. And their revenues actually accelerated at Azure by 2% from the December quarter numbers to the March quarter numbers. If you look at the two other big hyperscalers, Amazon and Google Cloud, their revenues actually decelerated from the December quarter to the March quarter. So after 9 months of misses, they finally had good things happen. And I think that's actually going to continue because of some of the structural changes that they've made. They invested heavily early. Now they're cutting back. The cash flow is going to go up. The return on investment is going to go up. And the traffic that they're taking from AI, because there's good traffic and there's not so good traffic, that traffic that they've kept is really good traffic for them. It's higher margin traffic. It's faster growing traffic. And that's why when they gave the data for March, they said, hey, we processed 100 million tokens in the March quarter. That was up 5x year over year. 50 million of the 100 million was done in the last month of the quarter. So those are some of the stats they've given you. And these things are like battleships, right? Where when it starts to turn, they tend to turn for a period of time, much like they had disappointments for 9 months. Now I think you're going to see upsides potentially coming. And so that's why, back in late April, early May, I said, look, Nvidia, after that big write down they had, like the favorite of mine. And I said Microsoft is the other one in the Magnificent Seven I like. And, so far so good. Those are the two that I really liked as we think of between now and kind of year end. And obviously, if you get a big correction in the fourth quarter, I'm sure they'll suffer as well. But I think you're going to see relative outperformance from both of those within the Magnificent Seven.
All right, so let me just push back for 1 second. If that is true, if you see this massive deceleration in CapEx, and again, we know this is not all GPUs, right? They're building out, a whole host of other infrastructure, right? But if it really is going to come down to, let's say, inference, doesn't that mean they need to, going forward, buy much less GPUs from Nvidia? I don't know how you can continue. Yeah, China is really important. They took that $5.5 billion write-off in the quarter. You know what I mean? So you're going to see China is going to be a massive acceleration for Nvidia. But if Microsoft is toning down their CapEx, we're going to see it probably from GCP, from AWS. Oracle is obviously gotten into the game in a big way. I just wonder if Nvidia, the moment that they actually have a guide that is just in line, to what consensus is, if that's something that halts at least the enthusiasm around Nvidia. Because, right now, Dan, people were making 3 months ago, 4 months ago, a valuation argument with Nvidia relative to, let's say, the Mag 7. But here we are this year, we're going to see, 50% earnings and sales growth. Next year, it decelerates to, let's say, mid-20s and then mid-teens in 2028. Well, the stock's trading right now at 39 times this year, 29 times next, 25 times. So you have to see meaningful upside to this current year, next year, to kind of justify this valuation, because competition eventually will come, right? I mean, I'm just laying that out there. Maybe it's too long term, but I just think that's something that makes sense to me.
Oh, yeah. No, I mean, I put out a note on NVIDIA, I think yesterday, and I talked about some of what you're bringing up. But here's the thing. When did I get bullish on NVIDIA? After they did the write down. When semiconductor companies do massive write downs, that's when you want to look at them, because then the numbers are all reset, right? China has been taken out of the revenue estimates. They have written down a whole bunch of inventory, which now they're going to get to sell at incredibly high margins. And so you de-risk that model for probably the next 6 months. That's how semiconductor companies work. And here's the other thing. If you're a company in China that's been cut off from chips and now you can buy them again, but you don't know, could that change in 3 months? You're going to see this massive surge in demand coming out of China, and the numbers are all going to go up. Now, by the way, I think you're going to have a massive problem at some point, because there's been a tremendous pull forward in buying of all kinds of semiconductor chips, as well as everything else. And we talked about ASML earlier, but back to, do people care? Last time I looked, the S&P, when we started the podcast, the S&P is still up. So as I said, it's not the data that matters. It's how people react to the data that matters. And so today you could have said, oh my God, the AI related stocks should be getting crushed. But people are trying to say, well, that's just an ASML thing. I'm going to just put this in the box because I really don't want my other stocks for this to impact that. And so people are trying to do, well, that's just company specific. And eventually, when every company has a company specific problem, then it's an industry problem, right? That's why I'm looking at how the market reacts to things like this, which could be taken massively negatively, and go, well, the market clearly doesn't care for now. And you just keep monitoring it as you go. But let's not forget what happened during the internet period of time. Cisco, for over a period of roughly 6 years, and they were the Nvidia of that internet infrastructure build out, their revenues went up 15 and a half times on a quarterly basis over 6 years. Never a down quarter sequential. And then in 6 months, the revenues went down, I think like 35% on a sequential basis, right? And so, yeah, are you going to get an overbuild in this AI stuff? Absolutely. Is it already happened in some cases, like with the Microsoft? Yes. That's why they're saying they're looking forward to being a renter of capacity. But from a global basis, you do have sovereign AI, you do have China, and everybody's racing towards this. The bigger issue is really what you saw with dark fiber following the internet build out, which is people are like, well, this new thing called the internet, people may want to like do things like stream movies. Well, that's going to require a whole lot of bandwidth. So we're going to need all this dark fiber. And then when it burst, it took over a decade to burn through all the capacity we had put through on dark fiber. And so I'm pretty darn sure human beings are all the same, right? When you've got 100 companies that all think they're going to get 10% market share, you're going to have a major issue on the other side of that. And right now, that's what you're seeing with AI, which is every company thinks they're going to do great. And that's obviously not going to happen. And so you are going to get this overbuild. But I think that is out, let's say a year from now, et cetera. And you're going to go through these boom bust periods. But if you look at Nvidia, their revenues are up about 7.4 times from the launch of ChatGPT. As I said earlier, Cisco revenues were up 15 and a half times. So I do think Nvidia revenues can double from here. If you sort of say, well, this is probably at least as impactful as the internet was, you could argue it's more impactful in that China's not super far behind. And some of these foreign countries aren't super far behind. And so that build out could continue. But you watch it, you figure it out as you go. Nvidia's stock went down 49% from intraday high to intraday low earlier this year. 49, right? So that's a big reset in expectations. And that's why in the near term, I think you're probably pretty good. But yeah, is there going to be an overbuild? Is there going to be a bust at some point? Absolutely. And it's going to be horrific when it happens.
But I think that's important. It lost nearly $2 trillion in market cap. Probably 1.5. And since then, it's gained $2 trillion. This is all in a matter of 4 months. And from a sentiment standpoint, the fact that folks are not particularly worried about that sort of volatility, like you're talking about Nvidia being able to, double their revenue over, a longer period of time. It's going to take years for that to happen. But right now, what is that discounted? And I would say nothing. From a sentiment standpoint, we haven't had that digestion period. You can take last summer out, that was down 11%. Yeah, a lot of these stocks were down a lot more than that. You know what I mean? But then we're making new highs within a matter of months. Let's take April out of that. I would say that's more macro and trade concern. It really wasn't about digestion. That was the period in which people started to care about valuation. You know what I mean? Like they're thinking about what a protracted trade war looks like. So that to me is something that eventually it's going to look very different than a macro sell-off. And I know that the way you are investing, you'll be very nimble about that. The market should start sniffing that out a little bit ahead of time.
Let me challenge you on one thing you said. There was a issue with demand in Q1 before the trade war stuff. Again, think about what I said. The Magnificent Seven, 6 of the 7 had revenue estimates go down for the March quarter when they reported the December quarter. 6 of the 7. The only one that didn't was Nvidia, and that was up a slight amount. What I would tell you is that the tariff stuff and the export controls have been good for demand because you've had this massive pull forward, because you've had a 38% year-over-year increase in imports. So in a weird way, all of this uncertainty has pulled forward a ton of demand. And your real read was when these companies reported in January of last year. If you go back and you look, the Magnificent Seven were underperforming to start the year before this tariff stuff got started. So to some degree, you're masking some underlying slowdown. So ultimately, that's going to show up.
No, that is fair. From the highs in February to the basically, I want to say early March, mid-March or so, the NASDAQ 100 was down about 12% or so. So it was kind of digesting that some of the thoughts as you're heading into Q1 guidance, I guess is really, or Q1 results, that sort of thing. That makes sense. And so I'm glad you pushed back at my pushback. Let me ask you this. This is a little cynical, okay? But I wanted to get your take on this. And so, I think it's kind of snarky. Everyone's like, okay, all these big tech overlords, they want to get to AGI. No one really is able to define exactly what AGI is, right? But they're all racing for it. And so, I wonder if before AGI or Skynet kills us all, whether these overlords are likely to kill each other. So I was thinking about this. Okay. So Sam Altman hates Elon, right? Elon hates Altman, and they both hate Zuck, and Zuck hates them. Satya, if he doesn't already, is going to hate Sam Altman. Sundar hates Perplexity. Cook hates the fact that he missed AI, right? And so they all actually bow at the altar of Jensen Huang. And then I'll just take it one step further. Secretly, Trump hates them all. You know what I mean? So, like, I just think it's like a funny scenario here. Everybody's tiptoeing around each other or walking on eggshells or something like that. But I feel like the competition has not really gotten nasty yet. You know what I'm saying? And as far as I can remember, and you might be able to kind of, dispel me of this belief, I just can't remember where it was Gates hates, Jobs and this and that or whatever. Well, they all ended up working together, and they ended up kind of, benefiting from some of that working together, like that sort of thing. So maybe I'm wrong. I don't know. Did Larry Ellison, did they all hate each other? Did it thwart progress or this and that, or whatever? But this one right now is different because the stakes and I think the moats and the managements and the legacies that these guys are focused on, and not missing what they think is probably 5x of what the internet was.
A lot of the Magnificent Seven kind of had their own lanes, and so they weren't encroaching on each other's territories. And then that kind of started to change with the hyperscalers. So Microsoft, Google, not as much Google, but Microsoft and Amazon. Amazon being the biggest hyperscaler, then Microsoft with Azure kind of being the second biggest. They started to encroach a little bit on each other, but what you've seen with AI is now you've got big encroachments where they're all in each other's turf to some degree, where you've got Meta spending a lot, and OpenAI is, you could put them in as the Magnificent Eight if you want, because they're causing issues in terms of search for Google. And then Apple's got issues with, well, is Google going to pay them $20 billion? I don't think that's going to happen in the future. Or is Apple going to go off and buy somebody like a Perplexity, which I think they should, to fix their AI issues? And so you're going to see, I think, to your point, and then obviously Tesla is developing their own AI technology, and they're getting into things like robo-taxis where Google has a lead with Waymo. And so there's going to be conflicts there. So yeah, I do think you're right. You're going to see increasing conflicts between all these big players. I mean, robotics is the next level of that, where you're going to see some battles between these guys in that space, like an Amazon versus a Tesla in particular. And so, yeah, it's going to get rougher where these companies are in each other's turf a whole lot more, I think, in the future. And AI has a lot to do with it.
Attention. You were one of the 15% of Americans in 1995 that was on the internet. Okay, just think of that, right? 15%. And then if you think about right now, we're basically at 100%. You have to live under a rock if you're not using the internet, right? And then you think about, let's say, AI. Here we are, 2.5 years for the most part after ChatGPT was released. Okay. And right now, some of the surveys I've seen is that probably half of Americans have used a chatbot already. So think about that. Within a few years, it'll be ubiquitous. It'll be like Google searching right now, that sort of thing. And so go back to 95, and you know what the performance was like for 5 consecutive years. The S&P 500 gained 25%. So if we've accelerated these cycles, if this technology is already being adopted in a way that, a lot of internet companies back then could have only dreamed of, is this the thing that helps you justify, as we're getting to some of these rich valuations? And I know that you just said this, is like people care when things are going, like irrationally exuberant or irrationally, depressed, that sort of thing. I'm just curious, does this fit into your mindset a little bit, what you remember from, let's say, 30, 25 years ago?
Yeah, absolutely. And I do think things have been accelerated because, unlike with the internet build out, you go back and you think about it, you had a lot of very unprofitable companies raising a lot of money from public markets and debt markets to fund build out of the internet. This time around, the companies that are doing it are the ones with the biggest balance sheets in the world. It's Microsoft, it's Google, it's Amazon, it's Meta. And so their ability to fund this stuff and drive it without having to go do a big public offering of debt or equity, it's just amazing. And so that's what makes this acceleration and adoption partly happen so fast. The other thing, as we talked about earlier, is China's got half of the world's AI researchers, half. And so, unlike with the internet, these foreign countries aren't super far behind. And so, you've got this simultaneous investment going on across different regions of the world. And now, obviously, with the Middle East, you've seen some of the deals that were struck there. And so, the build is going to be that much more aggressive. The adoption is going to be that much quicker. But, at some point, you're probably going to have to deal with the other side of that. And the cost piece is the one I'm super focused on, because if the cost to deliver inference at scale continues to drop dramatically, then the amount of hardware you're going to need at some point is going to be much less than you imagined. And so those are the things that are rattling around in my brain. And if you want to get into real specifics, the one data point I thought about, putting something out on it, decided not to, because people always get confused when you give them too much data to some degree, is if you look at Han Hai, right, they give you monthly numbers. And Han Hai, for those who aren't familiar, they produce the Apple iPhones, and Apple's probably 30% of revenues. If you put in all the companies that supply into Apple, it's closer to 40. But the other big portion of their business, which is over 30% of revenues and has been growing dramatically, is AI and Nvidia related AI, building racks and other stuff. If you look at Han Hai's revenues, April was up 26% year over year. May revenues were up 12% year over year. June revenues were up 10% year over year. If you look at it quarter by quarter, Q1 was up 24 and Q2 was up 16% year over year. And you look at that and you go, wait a minute, if AI demand's that good, why are the revenues decelerating like this? And by the way, you combine that with what's going on at ASML, and does it matter near term? No, because nobody wants it to matter. At some point, is it something you need to think about? Absolutely. And so those are the things you kind of watch. And I remember watching these types of things in 1999, and the market just continues to levitate into 2000. And then obviously when you hit a wall, it's that much worse than you thought. But for right now, could the market go up between now and Thanksgiving another 10% plus? Sure, I can see that, because valuations aren't as crazy as they were in 2000, and people just want to believe. So this is going to be a really fascinating period of time, I think, over the next 6 months.
Well, by the way, that little nugget on Han Hai, I mean, that is so interesting. And there are so few people that are connecting the dots like that, certainly not on the sell side. And this goes back to process, the fact that you remain bullish going back to 2 months when things got really oversold. You've articulated some differentiating thoughts about this Mag 7. You don't look at it as a monolith. And I think that's really important. So these are the sorts of things when I am so fortunate to have you come on as frequently as you do. And I think our listeners, you are a fan favorite, because I think they not only learn about what you're looking at and how you're looking at it and the inputs, but there's a process there. And I think that's really helpful. So Dan, I really appreciate you being here. If you guys are not following Daniel T. Niles at Twitter, you should be. And then obviously, if you want more information on Dan and what he does and where he does it and how he does it, go to nilesinvestmentmanagement.com. So Dan, thanks so much for being here again. I appreciate it.
My pleasure, Dan.